The first 4 chapters of our book focused on service businesses, like consultants who simply provide service. When we get to chapter 5, we talk about businesses that sell things. So before a business can sell a thing, it either has to make that thing, which we'll talk about a lot later in accounting class, or it has to buy that thing from a supplier and then sell it to its customers, hopefully for a price greater than the cost of the thing. Chapter 5 can be kind of confusing with a bunch of contra revenue accounts, FOB destination, FOB shipping, etc. So let's start with the real basics of a sale of a thing and see if that doesn't help you understand exactly what's going on in chapter 5. So let's assume that we own this corner market and we want to sell a bottle of bleach. The first thing we have to do is we have to buy it. So we go to Clorox company and we buy a bottle of bleach. Let's say we buy it for 90 cents. In the language of debits and credits, what happened is our asset inventory increased by 90 cents and our asset cash, let's assume we pay cash, decreased by 90 cents. So we debit inventory for 90 cents and we credit cash for 90 cents. Now let's assume a customer comes into our store and wants to buy that bottle of bleach. And let's assume that she is going to pay cash. So let's first of all book the sale. What's happening to cash from our point of view? It's going up. So we debit cash for $1. We also keep track of the sale in this revenue account called sales. So it's really important to understand that this sales account keeps track of our sales. Whether we get paid today, tomorrow, or never, we keep track of the revenue that we've earned in that account. It is not cash, it is our revenue account, right? Now if we're in the perpetual inventory system, we also perpetually update our inventory. So what's happened to this bottle of bleach is it has come out of our inventory and gone home with our customer. So we're going to have to book that decrease in our inventory account. So what we do is we credit inventory for 90 cents. That's what that bottle of bleach cost us. And we debit cost of goods sold for 90 cents. Cost of goods sold is an expense account. Expenses are debits, expenses are debits, expenses are debits. So it makes sense that this cost of goods sold account would increase with a debit. In our accounting cycle, if we were to stop doing business right now and that were our only transaction when we got to step 7 of our accounting cycle, we would look at our adjusted trial balance and we would have a revenue account of $1, an expense account of 90 cents. So we'd have sales minus cost of goods sold for a gross profit of 10 cents. 10 cents divided by our $1 worth of sales means a gross profit margin of 10%. In fact, our cost of goods sold is such an important expense in the merchandise business that we list it first, subtract it, and come up with the gross profit number. So that's all there is to booking a sale of things. What makes it challenging are these accounts up here above our net sales. Returns and allowances keeps track of our dissatisfied customers. These are called contra revenue accounts. Returns and allowances are really 2 different kinds of transactions, but they both represent dissatisfied customers. Returns means the customer actually bought back the bottle of bleach to us. So we would reverse the sale transaction and we'd also put the bottle of bleach back into our inventory. But when we reverse the sales transaction, we don't debit sales. Instead, we would debit this returns and allowances account because we want management to keep track of our dissatisfied customers. Allowance is also a dissatisfied customer where we knock a few bucks off their invoice. So we send them an invoice for $1. They call up and say we're dissatisfied. We say, what if we knock a nickel off and only charge you 95 cents? And then they say, okay, now we're satisfied. That nickel reduction would show up in this contra revenue account where we keep track of our dissatisfied customers. Discounts are customers that pay us early. To encourage our customers to pay us early, we'll offer them discounts. 2-10 net 30, for example, means if you pay us within the first 10 days, you can take 2% off this invoice. If you don't pay us within the first 10 days, you owe us the whole amount within 30 days. So returns and allowances keeps track of dissatisfied customers. Discounts keeps track of our customers that pay us early. But mostly what I want you to remember is that this sales account is our revenue account, and it keeps track of our sales, whether we get paid today, tomorrow, or never. It's not a cash account. And what we're trying to do is come up with a gross profit number that represents those sales minus our cost of goods sold to give us our gross profit. Hopefully with that basic understanding, you'll be able to read chapter 5 and it'll make a lot more sense to you. Thanks.